Welcome to today's Explainer. All right, we're going to break down a fundamental financial insight today that is, well, it's a total paradigm shift. We're talking about why your debt might actually be your absolute best investment. Now, I know, that sounds completely backwards right out of the gate. It's a paradox. But stick with me here because the data we're about to explore, it's going to completely reframe how you look at your money. Let's just dive right into the math.
So, what's the best investment you can make today? Genuinely think about that for a second. If you had some extra cash just sitting in your checking account right now, where would you put it to really maximize your financial future? We usually think about buying real estate, right? Maybe starting a side hustle or putting that money to work in the financial markets. We're constantly on the hunt for that perfect vehicle to multiply our wealth. But what if the absolute best answer to this question isn't about buying a new asset at all? What if the answer is actually hiding in plain sight, literally tucked away inside your wallet?
To answer that, let's set up a little competition based on our source material. In one corner, we have our first contender, the stock market. This is the classic, the traditional, the most widely accepted route of investing. It's the default answer for millions of us when we think about growing our wealth, you know? When we talk about building a nest egg or planning for retirement, the stock market is almost always the very first thing that comes up in conversation. And hey, it's undeniably a powerful wealth-building tool. But today, we're putting it in the ring against a completely different kind of financial strategy. Historically, the projected return of the stock market sits right around 5.9%. But I want you to pay really close attention to how our source material actually describes this return. They call it hopeful. A hopeful 5.9%. Man, that one word does a lot of heavy lifting here. It introduces a very real seed of doubt, doesn't it? Because when you put your money into the market, you're operating on a projection. You're basically crossing your fingers and hoping that economic conditions, corporate earnings, and overall market trends all play nice and deliver that return back to you. It's a solid historical benchmark, for sure, but by definition, it's an expectation. It's definitely not a promise. Enter our second competitor, the heavyweight champion, credit card debt. I know, this completely flips conventional wisdom on its head. We almost always view credit card debt strictly as this crushing liability, right? A total burden, a financial sinkhole. We rarely, if ever, frame it as an opportunity. But our source material challenges us to look at this debt through the eyes of an investor. If you reframe paying off your credit card not as just, settling a pesky bill, but as an active deployment of your capital, the whole picture transforms. It literally stops being just a liability and becomes an incredibly lucrative financial vehicle.
And here is exactly why it earns that heavyweight champion title, 22.15%. Just let that massive number sink in for a second. According to the data we're looking at, this is the average return of paying off credit card debt. See, when you carry a balance, you're getting charged this exact interest rate. So by turning your capital around and paying off that balance, you're instantly saving yourself from a 22.15% loss. And in the mathematical world of investing, a penny saved from interest is exactly the same as a penny earned in returns. By eliminating this debt, you are locking in a staggering 22.15% return on your money.
When you actually compare these two side by side, the reality of the math is just undeniable. That 22.15% return from wiping out your credit card debt completely dwarfs the stock market's 5.9% projection. It's nearly 4 times the size. When you strip away all the emotion, all the standard advice you've always heard, it all boils down to pure mathematics. If you have a limited amount of capital to deploy, the math just flat out dictates that putting it toward that massive 22% return is vastly superior to chasing that much smaller projection.
Ultimately, it really comes down to two very distinct words directly from the source material: hopeful versus guaranteed. This is a completely stark binary choice. It's the choice between taking a risk for a smaller potential reward and locking in absolute certainty for a massive reward. Look at it this way. When you invest in the market, you hope for 5.9%. When you pay off a credit card charging 22.15%, you mathematically guarantee that you keep that exact amount. No random market volatility can come along and take that away from you. The absolute certainty of that return is what makes it so incredibly powerful.
Which actually shifts our focus to the next major insight here. Why do people fall for those crazy get-rich-quick schemes in the first place? Well, human psychology is naturally drawn to the promise of incredibly high returns, right? We all kind of want that shortcut to wealth. But the profound irony our source reveals is that you don't actually need a sketchy scheme to find sky-high returns. You already have access to a financial maneuver that yields over 22%. By strategically redirecting your money to pay off credit card debt, you're executing a financial strategy that actually delivers the massive numbers those wild schemes only pretend to offer.
Let's break down exactly why this is the ultimate financial move. First up, It's a risk-free return. As we were just talking about, there's literally zero market risk when you're paying off a known debt. You can't lose the money you've saved on interest just because the economy takes a dip. And second, and this is huge, it's a tax-free return. Think about it. If you actually manage to pull off a 22.15% profit in the stock market, you'd have to pay taxes on those capital gains, which shrinks your actual take-home return significantly. But the money you save by avoiding credit card interest, the government doesn't touch a cent of that. It is entirely yours to keep. There's this one quote from our source text that just perfectly crystallizes everything we've been unpacking today. It says, paying off debt is a risk-free, tax-free return that beats any get-rich-quick scheme. And they hit the nail right on the head. When you combine a guaranteed, incredibly high double-digit return, strip away all of the market risk, and then completely remove the burden of taxes on top of it, you're left with a single most efficient, mathematically sound wealth-building strategy available to anyone carrying a balance. It really is that simple, and it really is that powerful.
So, I want to leave you with this one question to think about. Will you chase a hopeful 5.9%, or will you guarantee your 22.15% today? The data we've looked at overwhelmingly supports one clear path. The next time you're sitting down and deciding how to allocate your money, take a look at the balances you carry, remember what we talked about in this explainer, and just ask yourself which number you'd rather have working for your financial future. Thank you so much for joining me for today's explainer, and as always, keep following the math.